Hi, I'm Linda Eedes. This is an update on the RECM Global Felxible Fund, looking specifically at the third quarter of 2018, talking to the returns and the source of those returns, and then also how the fund is positioned currently, particularly within the context of the global backdrop. So by way of reminder, this is our multi-asset class, fully flexible fund, which really is a fancy way of saying that we are able to invest wherever we see value, whether that's locally or globally in any asset class. So that gives us a lot of flexibility to find value for our investors. And what we commit to you as investors is that over time, we will generate a return net of fees above inflation plus 6%. And I can say today that we have managed to do that since the fund started in 2003. So we've been managing this fund now for 15 years. It's our longest running fund. It is, in fact, I would say our flagship fund because it does give us that full opportunity set. And the fund has generated 11.9%, just shy of 12% per year since 2003. So that is about almost 0.5% above the benchmark, which is inflation plus 6% per year for that 15 years. Over the last quarter, the fund actually was flat. But that's sort of not too bad if you consider the fact that the South African equity market was down 2.2%, although having said that, the global equity market was up. But year to date, this fund is faring very well. It's up 6% in South African rands. Some of that is as a result of our global equity exposure, and because the rand obviously depreciated, that translated in rands into a positive return. But I think that is something worth mentioning. I mentioned the flexibility of this fund. We don't just, as a matter of principle, hold global assets to sort of externalize assets in South Africa. We actually look at the sort of full opportunity set, and we take into consideration where the rand is, and we do move quite actively between sort of local and global equities where there's value. So it's not a static kind of 60% in South Africa, 40% global, or vice versa. And that has actually contributed quite strongly to returns because you'll probably recall that in early 2018, the rand was actually very strong. There was a lot of positive sentiment around Cyril Ramaphosa coming in as president, and that reflected in the currency. And at that time, we actually had quite a lot of South African exposure, having moved a lot of assets into South African equities after 2015, when Nhlanhla Nene was fired. South African rand blew out quite substantially. And at the time, we moved more onshore, and basically we benefited from that. And then when the rand was very strong, we actually moved back sort of into global equities. So I think that sort of the fact that we use that flexibility quite actively is an important point, because I think as an investor, investors come to us and say, I don't know what to do. I don't know whether to be here or there. I don't know what the rand's going to do. You decide for me, but I want you to give me a decent inflation-beating return over time. And I think that we've done that quite successfully thus far. As it stands, the portfolio does still have more global assets than it has local assets. The rand is not at the same levels that it was in 2015, even in absolute terms. But remember that our inflation is much higher than, for instance, the US. So that necessarily means that our currency has to depreciate by a certain amount every year in order to sort of make the purchasing power parity of both economies equal. So the rand's not at the sort of levels that we would consider attractive yet. So we do have more sort of global assets, and it's sort of a split of about 60% global equities, 40% local equities. So if you look at the last quarter, some of the things that contributed to returns were, for instance, our exposure to Berkshire Hathaway. The US saw rising interest rates there. The economy is very robust. It seems to be turning the corner, growing quite nicely now. Unemployment rates are at 18-year lows. And Berkshire Hathaway, despite being sort of most famous for Warren Buffett being one of the shareholders, and the founder of the business, is actually sort of got a very strong insurance component to it. So insurers tend to do well with rising interest rates, which is why the share price probably was up during the quarter. Other businesses that did well on the global side were Williams-Sonoma, which is a big luxury homeware retailer. That business The share price was down quite a while back when we introduced it into the portfolio because the market assumed that Amazon was going to wipe it out because it did have quite a strong online presence and Amazon was sort of moving into that homeware segment. But they recently sort of came out with results which showed that they were a lot more resilient than the market expected them to be. And in fact, their online sales have actually increased despite the fact that Amazon has been trying to get into their market. So the share price reflected that. And often that is what happens with the sort of stocks that we buy. We buy businesses, high quality businesses, businesses that have a good long-term track record. But unfortunately, you're not going to buy those businesses at good prices if everything is going well. There needs to be some sort of negative sentiment. There needs to be some sort of adverse circumstances that the company is facing. There needs to be a reason why the share price is actually coming under pressure. And that's when we sort of take a long, hard look at those companies and decide whether that reason is a temporary reason or a permanent reason. And that represents one of those sort of examples. Where are we finding those kind of opportunities today? Well, we're taking a long, hard look at a lot of emerging market businesses. We do still have quite a bit of exposure to the UK. The UK did come under a bit of pressure over the quarter, a lot of uncertainty around how Brexit will play out. That did affect a lot of UK stocks, including Tesco, which is one of the top sort of global stocks in our portfolio. And on the local side, sort of the Rand weakened, but it was a really mixed bag. I mean, Naspers was down quite substantially during the quarter. It was down 12%. The fact, obviously, that we're not positioned close to the market was a real contributor to our returns in relative terms, although obviously we think more in absolute returns. We have an absolute return benchmark, and that's what we seek to produce for our investors. But I think it is a good reminder why value portfolios work within the current climate. Year to date, our equities on the local side are actually flat, whereas the South African equity market is down 10%. In fact, it's come under even more pressure since the end of the quarter, whereas our portfolio is remaining quite robust. And it's really because we positioned away from sort of the widely held stocks in the market, which are coming under quite a lot of pressure at the moment. So I think it's just a good reminder of why it is good to have that sort of value-oriented portfolio to give you the opportunity to benefit when maybe the rest of the market is coming under quite a bit of pressure. To conclude, I just want to sort of give you an overview of how the fund is positioned and why sort of we believe that makes sense at the moment. So if you sort of look, first of all, I spoke about the flexibility between local and global, which I think we've used to our investors' advantage. So that's something that differentiates this fund, I think. And then looking at those separate components, if you actually look at the global equities, one thing that I think should be very reassuring for investors is that the global component of the portfolio has produced very good returns over the last 3 years, but it's not because we hold the big technology stocks. So a lot of global funds do have quite a lot of exposure to technology. It is why they've done well, but it's also why they're quite vulnerable at the moment, with a lot of these risks sort of starting to come to the fore now. This portfolio is built in a very different way to sort of the average global fund, which is more closely aligned to the MSCI All Countries World Index, for instance. It doesn't have a lot of exposure to the US. We've deliberately looked for opportunities away from the US. It's got exposure to very different businesses. We look at each business from the bottom up, look at what we believe sort of a good estimate is of the fair value for that business, and then wait for an opportunity to actually buy that where the odds are stacked in our favor. We look for as many different investment ideas as possible across different geographies and different sectors, and it's not highly concentrated with exposure to the technology sector. So I think that should be of some comfort to investors. Why? Because it means that we're not dependent on the status quo continuing for this segment of the portfolio to do well. So I think that should be reassuring. I mean, it's incredibly difficult to work out what all the sort of different moving parts in the global macro environment are going to boil down to. So what we do as value investors is we break it down into manageable pieces. And what are manageable pieces? Well, the one thing you have control over is what businesses you buy and what price you pay for them. So we look at the economics of each specific business, and that you can actually sort of ascertain with a reasonable degree of accuracy. Trying to figure out what's going to happen in the global environment is virtually impossible. But if you actually break it down into that, you can actually get somewhere. And I think the portfolio as a result is very robust in terms of all the sort of uncertainty that surrounds global equity markets in general. On the local side, the portfolio has got quite a lot of exposure to small and mid caps where there is a lot of emerging value. As a smaller asset manager, we're able to take advantage of the full opportunity set. The Aussie 40 is down more than 20% year to date. I think that a lot of the large caps have come under a lot of pressure, which means we'll probably be taking a closer look at some of them. But it does mean that we have the ability to move away from sort of the risky parts of the market where valuations are still not where they should be to represent value. So I think that combination of the way that we invest, the fact that we're able to invest across the full opportunity set, and the fact that we're positioned away from the market is really stands the investor in good stead as far as a robust portfolio which should continue to deliver the inflation-beating returns it has done over the last 15 years.